You know, when we talk about a country's economic health, there's one number that gets a lot of attention: foreign direct investment, or FDI. And if you've been following the news about India, the headlines have been absolutely glowing, talking about record-breaking investment. But as you're about to see, behind those huge numbers, there's a very different story unfolding. Let's dig in.
So get a load of this number. In the 2021-2022 fiscal year, India brought in its highest ever annual FDI inflow, a staggering $83.57 billion. Now, when you see a number like that, your first thought is probably, wow, the economy must be on fire. Foreign investors are really betting big on India. But here's the thing about big, flashy numbers. They don't always tell the whole story. Sometimes they hide something much more interesting.
So, to really wrap our heads around what's going on, we first need to get our terms straight. Because, you see, not all foreign money that flows into a country is the same. There's what you might call a gold standard of investment, the kind every country is hoping to attract.
And that gold standard is this: foreign direct investment. Think of FDI as a real long-term commitment. It's when a foreign company doesn't just, buy a few shares on the stock market. No, they're investing to build or buy actual physical assets, like a brand new factory or a controlling stake in a local business. And here's the really crucial part: it's non-debt capital. It's money coming in that doesn't add a single penny to the country's national debt. But FDI has this, let's call it a cousin, foreign portfolio investment, or FPI. And the difference between them is absolutely critical. Here's an easy way to think about it. FDI is like buying a house in a neighborhood you plan to live in for years. You're invested, you're committed, you're part of the community. FPI, on the other hand, is like day trading stocks of companies from that same neighborhood. You're just there for a quick profit, and you can sell out and disappear in a flash. One is stable and builds things, the other is volatile and can be gone tomorrow.
So why this obsession with FDI? Why do governments practically roll out the red carpet for this specific type of investment? Well, because when a country gets it right, it can be completely transformative for the economy.
I mean, the benefits are just immense. FDI brings in the huge amounts of cash needed for big projects like new highways or power plants. It transfers advanced technology and new management skills. And maybe most importantly, it creates jobs, and not just in the new factory itself, but all along the supply chain. It helps boost exports, it strengthens the currency. This, right here, is why that $83 billion headline seemed like such fantastic news.
Okay, but this is where our story takes a very sharp turn. Because while that headline number, the gross inflow, is really impressive, there's a disturbing undercurrent that changes the entire picture once you look just a little bit closer.
And here it is. Here's the plot twist, right in front of you. On the left, you see that massive amount of money coming in, the gross FDI. But look at the bar on the right. That's the net FDI. That's the money that actually stays in the country after you subtract all the investment money that's flowing back out. The difference? Well, it's just shocking.
Let's just put that number on its own for a second so it really sinks in. $500 million. That's the net result. To put it another way, for every $83 that came into India, about $83 went right back out. This means the actual, long-term, committed capital staying in the country has slowed to an absolute trickle.
So what's really happening here is that the nature of the investment itself is changing. We're seeing less of that stable, buy-the-house FDI and a lot more of that volatile, day trading type of money. Investors are putting cash into sectors like e-commerce to make a quick buck, and then they're cashing out and leaving, instead of building the factories and infrastructure that create real, lasting value.
And this, of course, begs the million-dollar, or I guess the $83 billion question: why is this happening? Why are these long-term investors either pulling their money out or just getting really hesitant to commit in the first place? What are the real issues here?
Well, a big piece of the puzzle is where the money is going. As you can see, a huge chunk is flowing into the services sector, things like software, trading, and finance. And while those are important, they don't always create the same kind of widespread blue-collar jobs that manufacturing does. Now, look at that smaller slice for manufacturing. That's the sector that's so critical for mass employment, and it's kind of getting left behind.
And if we dig even deeper, we find these 4 fundamental challenges that make long-term investors really nervous. First, trying to navigate complex regulations and bureaucracy can be a total nightmare. Second, gaps in critical infrastructure, things like roads and reliable power, add to the cost of doing business. Third, there's often a mismatch between the skills people have and the skills modern industries actually need. And finally, constant policy changes create uncertainty. And uncertainty is absolute poison if you're trying to make a long-term investment plan.
Okay, so we've laid out the problem and the reasons behind it. The good news is that these are not unsolvable issues. There's actually a pretty clear path forward to rebuild that investor confidence and start attracting the right kind of stable, long-term capital again.
The roadmap for this is really logical and comprehensive. It all starts with a massive push on infrastructure. We're talking roads, power, and digital networks. Next, you have to cut through all that red tape by simplifying regulations and taxes. Then, you have to invest heavily in training programs to create the skilled workforce that industries are looking for. Targeted, stable policies for key sectors, like the production-linked incentive schemes, are also super important. And really, underpinning all of this is the need to just boost confidence by making sure policies are stable and contracts are always enforced.
So, we end up right back where we started, but with a much, much deeper understanding. That big headline number, it's not the real story. The real story is this battle between attracting that fleeting short-term cash and building an environment that welcomes stable long-term capital. And the policies that India chooses to pursue next will decide which path it takes, ultimately shaping its economic future for decades to come.